Hey everybody, this is Rob Keynes reporting for JM Bullion on our weekly video blog. And today I wanted to talk about the prospects of inflation versus deflation. What is the history of that? And given the current inflation that we have now, is that going to continue, or we will revert to a period of deflation according to what we've seen in history, not only in the United States, but in another popular economy around the world, the United Kingdom? There's a lot of data out that suggests that after high inflationary periods, we slide into a period of deflation. And I'm going to talk about that and maybe how that could manifest in today's economy. I know a lot of people are worried about inflation. Certainly prices have been increasing, but the last 2 months of CPI reports from the government have inflation coming down from the 9% range into the 7% range. So it's come down a couple of points. Even though we do see some upward pressure on producer prices, it does appear that on the consumer end, they're reducing their purchases, and it looks like we may be headed into a deflationary period. On the heels of that knowledge and that economic data, we want to take a look at the history of it to kind of educate you as to what may take place. So we're going to share just looking at some charts that I researched and looking at inflation during deflationary periods. And this one is a cool one put out by the Fed. It shows inflation deflationary periods of the UK, source of the Bank of England, dating back to the 1200s. And you can see here, it's pretty obvious that we have periods of high inflation led by deflation, high inflation, deflation, high inflation, deflation. And that seems to be a consistent thing throughout the last several hundred years of that economy. And it goes to show that inflation doesn't last forever. A lot of times inflation leads to deflation because prices just get so high that people can't consume as much. And that's essentially, I think, what we're going to see here in the United States. Now, this is all cyclical. It runs in circles. So we have high inflation and then deflation and high inflation and deflation. The key is to see where we are at any particular point in time, because it will tell us likely what the issues we're going to see in the economy. And further, if you're purchasing precious metals, when may be the best time basically to buy them. Here is another chart from the Fed looking at total business inventories. And this is the amount or just the nominal value of inventory the business as a whole. Now, you would expect over time, as general inflation increases and prices increase, that the value of inventories would increase. And that doesn't necessarily reflect actually additional physical inventories. However, with the inflation rate being, a steady 2% for a long time or under 2%, and just now reaching, near double digits, not quite, you wouldn't expect, however, the value of total business inventories to rise forever or rise this much. And I think we can see that, accepting the last couple of recessions, the mini recession we had during the pandemic and the big recession we had, the Great Recession, 2008 through 2009, that accepting those recessions and even the tech crisis of 2000 to 2001, essentially what you see is continuously rising business inventories. And that essentially means that we just have more stuff. And when we have more stuff, that tends to, that's supply inflation, essentially, more goods. And if demand doesn't increase with the same, at the same amount, then what you have is a reduction in prices due to oversupply. And I think that's where we are right now. In fact, you can see since the pandemic, we had a reduction in business inventories because things shut down, right? But you can see here, they have literally sprinted upwards. The rebound from the closures in the pandemic meant that there was such immediate demand that we were producing an absolute ton of goods, and we ramped up and produced a ton. And then following that, of course, we had the container ship issues with goods getting into the US. And then I think once we cleared that up and we started getting goods in, demand fell, and now inventories have spiked up. And not only they spiked up, this is one of the largest short-term spikes over basically an 18-month time period that we've seen on the chart. This is almost a near vertical, not quite. It certainly is a lot stronger than the spike that we saw after the 2008, 2009. And it seems as though we're probably too heavy inventories given the consumer's purchasing power. And that's something we'll get into here in a moment. Before we get into consumers, one issue of stress in the economy has to do with corporate profits. In a previous article on the jmbullion.com blog, I highlighted the fact that accepting the recovery in the economy post this pandemic, which makes sense because we shut down and there was a lot of pent-up demand for goods and services. Aside from that, since 2018, corporate profits have been falling. And if you look at the recovery in 2021 of corporate profits, it doesn't make up for the crash in corporate profits in 2019. If you look here at the chart, this is from the BLS, negative 5.9% in 2020 during the pandemic. In 2021, we ramped up. And then we continue to ramp up until the current quarter 3 of 2022, where corporate profits have fallen. So we're resuming the trend since 2018 of corporate profits falling. And even though we had a nice little increase of 22% in 2021, it did not make up for the destruction in corporate profits dating back to 2018. In fact, not even close. And so companies have been making less money. That's because of rising costs and trying to keep prices down to attract consumers in an era in which you have rising prices and consumers are using more credit. And essentially, I think what we're seeing here is too much inventory. Profits are now going to fall because companies aren't going to be able to move necessarily all of that inventory, and it's going to put stress on there. And we see that starting to come the quarter 3 of this year. Of course, quarter 4 usually does pretty well in terms of retail perspective for companies because of the holiday season. So we'll see if retail will save corporate profits for the quarter 4 quarterly reports, which will come out starting January and February as companies do their year end and also do their SOX compliance and start to release that data. We'll see some of it as early as January, some of it stretching out into early March because of the early reporting requirements. But that will be very telling as to see how the economy fared overall in 2022. But so far in 2022, okay, but not recovering from the fall of the Great Recession. The one thing that I wanted to the fall of the pandemic in 2020. I wanted to take a moment and look at consumer credit. So this chart, I believe, is from the BEA, Bureau of Economic Analysis. And as you can see on the chart, it's just a issuance of consumer credit, or the percentage of use of consumer credit, or increase in consumer credit. So any number above 0 means an increase. So you would expect the line on a linear chart to go up. But what we're graphing here is basically like a period over period increase or decrease in consumer credit. And again, remember, consumers use credit until they can't. So they'll use credit to offset inflation or higher prices up until we have an economic crash. And you can see here, we had the Great Recession and consumer credit greatly fell. And what happened to prices is prices fell as well. Inflation fell during that period of time because people weren't buying anything, and the demand shock caused prices to fall amongst inventories. When consumers are using more credit and buying things on credit, businesses tend to expand inventories. This crash in consumer credit caused business inventories to accelerate, and therefore caused cost cutting in the corporate sector, and therefore caused a lack of profits for corporations. The same thing happened between the last recession, the Great Recession, 2008, 2009 to now. We had a steady increase in the use of consumer credit. We also had a steady increase in inflation. And whenever we had the pandemic, of course, consumer purchases fell. A lot of that actually had to do with closure of businesses and things. Consumers couldn't get things, and also supply chain problems. And therefore, consumer credit had fallen. And then we can see, of course, here the last 18 months or almost 2 years of consumer credit rising again. And not only is it rising, look at how quickly it's rising. It did rise sharply after the Great Recession, then moderated. We now have another uptick in consumer credit, which means consumers just don't have money to pay for the goods and services they need in a high inflationary environment with their existing budget. So they have to increase the use of credit, which means in subsequent periods, consumers are going to have less money. If think about it this way, as you use more consumer credit and you're paying off that interest, you have less disposable income every month to then use on subsequent purchases. So once you max out that credit and you deal with having to pay off that credit, purchases have to come down. And we think the pattern is going to resume where consumer credit use falls during a deflationary environment. And we think we're probably entering that period. Here's a nice one from the BLS with regards specifically to American inflationary and deflationary periods. You see at the beginning of the chart, we had the one from England. It was dating back, I think, to about the 1200s, 1300s. I wanted to show a more recent one from the US to show where we are. Of course, we see the same thing. So this is dating back to World War II, the last really great deflationary period where we had incredible demand and supply destruction because of the Great Depression and then the subsequent run-up of the wartime economy, and then what happened after World War II. So after World War II, we had very high inflation, and then it came down. Why do we have very high inflation? We had a lot of demand to rebuild the economy. We had demand of consumers wanting modern things like refrigerators and wanting to, it basically was the era of the expansion of the middle class. And so there was also a lot of pent-up demand. If you think about it, during the Depression and World War II, during the Depression, people didn't have money to buy things. And then during World War II, there was rationing and allocation of resources over to the war effort. So there's a lot of pent-up demand for people to buy everyday goods and services, as well as to participate in the expanding industrial economy and the goods and services that offered. Think back to the 1950s, where you saw commercials of advertising refrigerators, so people didn't have to have an icebox. They could actually plug in a refrigerator and use that to chill their food, or the ability of people to purchase goods and services locally at much cheaper prices and increase their lifestyle because of the development of new technologies that occurred after the war. So we had this inflationary period after the war, and then it fell, both in food, apparel, or the prices reduced in things like fuel, electricity, house furnishings, et cetera, et cetera. So again, we see this pattern of inflation, then deflation in the economy in the US, much like we have seen in the UK. And that is a pattern that has been established in Western markets. So we've had a period now of really high, substantial inflation for the last year plus, and we're starting to see some deflation occur because consumers have been maxed out because of that inflation. They're maxing out their credit cards. They cannot afford to buy all the goods and services they did before. So now we're starting to see signs that the economy is pulling back a little bit. We see that in corporate profits dating back to 2018. And even the pent-up demand from COVID has not solved this issue. We basically have satisfied that pent-up demand, and now what we have is increasing business inventories, as I showed you on the chart. Not only do we have that, but there are a lot of economic data statistics coming out that we cover on our weekly market wrap that you guys can watch right here on J.M. Bullion's channel that indicate that we're having deflationary forces in the economy. That's all the data is in there, and it seems to indicate we may be headed for deflation. And at the end of the day, the question is this deflation caused by a fiscal situation? Is it caused by geopolitical situation? What does the outlook look like for the world? And I think given geopolitical conflict, given rising energy prices, giving now deglobalization away from manufacturing, China doing all the manufacturing, people bringing manufacturing back in. I think we're going to see incredible deflationary forces with deglobalization, de-dollarization, heading maybe for the next year or so, and also dealing with a stressed consumer as well as dealing with a stressed government with higher borrowing costs on loans, and corporate America with higher costs across the board, higher input costs, higher labor costs, higher financing costs is going to reduce corporate profits. That's going to lead to, I think, a period of deflation in the economy. And then it'll be interesting to see what the central bank does and what the government does in order to deal with that. Because I think more than anything, the government and the central bank really don't want deflation because it screws up everything. The system was built on the expectation that we would have inflation, that inflation would be used to service debt, to address wages and things like that. But we see that wage price increases are not rising as fast as inflation. So I don't think we're going to see a wage spiral increase because we just simply don't have the demand that we had before. So how are you going to pay wages on a deflationary demand, especially when global profits are falling? I don't see how wages are going to rise to accommodate that. The next time I think we'll see wages rise substantially is when we get into more of a high inflation environment again, or a hyperinflationary environment, which seems to follow deflationary period. If you remember the charts, inflation, then deflation, inflation and deflation, and then every so often we have that cycle occurs, and then every so often we have a big clean out of the economy. And I think that's what we're heading to, is the big clean out. And that has to do more with not only the fiscal issues that we're having, but also the monetary issues, deglobalization and de-dollarization as well, and the establishment of a competing BRICS currency to the dollar. So I think we're headed into slightly different times than what we saw in 2000 and 2008. So it's worthwhile looking at all of this to kind of see historically where we've been in that cycle and compare it to now. I do think that we've had some supply chain issues, which led to inflation because it was supply destruction. And then the pent-up demand basically created additional supply, but we overran supply. Now we have way too many supplies and of certain items, and so that's led to an increase in business inventories. However, supply chain issues, commodity availability issues will lead to scarcity of certain types of goods, including energy. So I think what we're going to see is deflation in general prices, but we'll see maybe an increase in certain types of energy prices and things like that. And that's to correct the overinflated economy. We had not only from the restart of the pandemic, but dating back to the 2008, 2009, the Great Recession. So that's a little bit of a look into what happens, inflation versus deflation, a little bit of a preview into 2023 and what we may see. Of course, we always, every single week, do the market recap where you look at the economic data. We'll cover that for you and we'll continue to bring you that on the channel. Thank you so much for being a part of the channel. But before we leave, ladies and gentlemen, I wanted to talk to you about the coin of the week. And the coin of the week this time, for me, I just absolutely love the World Cup. I played soccer growing up. It was a big thing when I was a child. Gosh, I think I played it when I was 4 years old, and I played all through high school in the rec leagues. And in high school, we simply, did not have a team. So we organized our own team and played. And I just love soccer so much. And I remember watching the World Cup back when nobody in the US was watching it. And then it came to the US in the late 90s, and it was so exciting. And my friends who had played soccer were very into it. I was very into it. But most people in the United States weren't quite. But in the late 1990s, the US, I think, for the first time qualified for the World Cup, built a team because they were going to be hosting it. And I think got almost as far as the quarterfinals, and had one of their best showings in history. Now, it's been a struggle since then for the U.S. to compete in the World Cup stage. Or certainly not in the final bracket. But we do have some surprises. We have Argentina behind Messi's last season, really making that run. They defeated Croatia 3-0, and Croatia is a very, very strong team. And it looks like they may be headed for a showdown with the winner between Morocco and France. Morocco is a Cinderella story in the World Cup, and it's been a lot of fun. So with that in mind and all the festivities going on, I wanted to bring you my basically coin of the week, which ends up actually being a silver soccer ball. It's the Solomon Islands silver soccer ball spherical coin. It's really cool. I mean, just look at the coin. I mean, look at the detail on the coin. Look at what I mean, gosh, look at that. That's just a beautiful coin. Of course, you have the Queen's picture here. You have the symbology of, the World Cup. And it's 3 troy ounces of pure silver, and it's just an absolutely gorgeous piece. And definitely I'll be adding one of these to my collections. I love stuff like this that is a precious metal, but also symbolizes something very important to me. So if you're following that World Cup and you're interested, I highly recommend going to JM Bullion and maybe taking a look at that soccer ball, which is really, really cool. And of course, as I go out to eat at the bars and things locally, huge US crowds around the World Cup. I think in the US has finally caught the bug. I know a lot of my friends follow, the Premier Leagues and the European leagues in soccer, and it's definitely become a more popular sport. So interesting to see about 40 years after I started playing soccer that finally it looks like Americans are really getting into it. And so I expect there will be a lot of interest in silver related sports items and anything commemorative of the World Cup, which is really cool. All right, that's going to do it for this video. Everybody have a wonderful weekend. Make sure for additional research to go to jmbullion.com/blog and read the blog entries that we have there. And I know that if you sign up for the JM blog newsletter, they'll send that notifications out to you as well for new content. So be sure to sign up for that on their site. All right, without further ado, this is going to wrap it up for the JM Bullion report and talking about inflation versus deflation and a preview of what we may see in 2023. Till next time, this is Robert Keens of Gold Silver Pros.